Top dividend stocks. As the world remains on the verge of a recession, the stock market is one of the first areas to feel the heat of this global economic meltdown. Stock prices continue to plummet while companies scramble to solve their financial woes and balance their books. However, market fluctuations create value opportunities that smart investors can take. Even with this market crisis and looming recession, some stocks have continued to do well, yielding high dividends. In accordance with our goal of breaking people free from the shackles of financial instability and ushering them into a new level of financial freedom, we will be discussing 5 top dividend stocks in our video today. After doing our due diligence and researching top stocks paying high dividends, our team has specifically chosen these 5 stocks as the best paying high dividend stocks on the stock exchange. So guys, get ready for another opportunity to hit it with dividend stocks. If you enjoy our content, hit the like and subscribe buttons so that life-changing videos like this can keep blessing your feed. Make sure you also stay till the end of this video because we have saved our favorite stock pick for last. Verizon, VZ. Verizon is probably one of the most popular stocks out there today, and it is no surprise that it comes first in our stock pick as it has been doing well recently. As one of the biggest telecommunications and wireless network operators in the United States, Verizon has more than 140 million subscribers. The company developed the first 5G network, and its 4G LTE network covers about 99% of the US population. The company has over 2,300 retail stores in the US and provides services that include wireless broadband services, internet services, mobile phones, and home telephone services. The telecommunications powerhouse lost many subscribers during the pandemic, as up to 70% of the company's stores were closed due to the coronavirus outbreak. This led to the company's stock dropping to around $51. However, with more people staying at home and Verizon's innovations to tackle the pandemic, one of which is acquiring other companies such as BlueJean, the stock soon bounced back. The company reached a high of around $61 in November 2020 before declining to approximately $37 currently. With a dividend yield of almost 7%, VZ has outperformed its 4-year average by nearly 40%. The company also had a decent dividend payout ratio of 48%. On September 6, 2022, Verizon announced that it was increasing its quarterly dividend by 2% to $0.6525 for the November 1, 2022 payment, extending the company's dividend growth streak to 18 consecutive years. The company is also on a good run to become a dividend aristocrat soon after paying dividends consecutively for 22 years. The company's ability to generate cash flow is one of the things that we considered before we picked this stock. The stock numbers are not bad either. VZ's earnings per share rate has grown by about 10% in the last 10 years, while its dividend growth rate has been around 3% in that same period. In the next 5 years, our conservative model projects that the EPS and dividend growth rates will stand at 4% and 2% annually, respectively. On October 21, 2022, Verizon announced third-quarter earnings results for September 30, 2022. Revenue grew 4% to $34.2 billion, topping estimates by $410 million. This was backed by a 10% annual return on invested capital. Over the last decade, the company had an ROIC of 9.9%. While investors may not see a significant increase in earnings growth, Verizon offers a very high and stable dividend yield. Although rising interest rates and other economic issues have put pressure on the stock, it still maintains an attractive valuation. The company's ability to retain its subscribers, as it is considered by many as the best wireless service provider, is a crucial advantage that has worked for the company in generating high returns over the years. Currently valued at around $37 and with a 5-year estimated annual return of 17%, now may be the best time to consider investing in this stock. 3M Company, MMM. Next up, guys, one of our top dividend stock for today's video is 3M Company, one of the best conglomerates around today in terms of consistent dividend payments and high yield is 3M. 3M is an American multinational conglomerate that operates in several industries, including worker safety, U.S. healthcare, and consumer goods. The company produces over 60,000 products under several brands, such as medical products, adhesives, personal protective equipment, electronic circuits, etc. You may have used or are currently using the company's products. The company made over $35 billion in revenue in 2021 and has over 90,000 employees. 3M was hit during the coronavirus pandemic as the company's earnings declined due to a plunge in demand across the company's business units. 3M's stock price was down by up to 30% during the pandemic, hitting a low of around $125. It took almost a year for the company to recover, rallying to about $209 in May 2021. Following a bearish run, the stock is currently trading at around its COVID price of $124. However, the company's valuation and fundamentals still look solid, as it has shown over time to be very good at risk management, even in the face of several macroeconomic pressures. It has managed the risks of supply chains and other short-term cyclical problems and ranks in risk management among the top 18% of the world's best blue-chip companies. Let's go through the company's financials. The company currently has a dividend yield of 4.7%, one of the sector's highest dividend yields, and this value is above its 5-year average of 3.5%. With a dividend payout ratio of around 48%, 3M remains within its historical average. This means that the company is comfortable with dividend payments. After all, it's one of the few companies on the elite list of dividend kings. 3M has paid dividends for 64 consecutive years. On February 8, 2022, 3M announced it was raising its quarterly dividend by 0.7% to $1.49, extending the company's dividend growth streak to 64 consecutive years as well. In terms of growth metrics, the company has had steady growth. Over the last 9 years, the earnings per share grew by 5.5% annually, while the dividend growth rate was 10.8%. We think the growth will continue at 5% annually for earnings per share and 2% for dividends in the next 5 years. The company's ROTC has been relatively constant over the years, averaging 20.1% annually. Our conservative model suggests that 3M, currently priced at around $127, will give a 5-year estimated annual return of 14.8%. With a solid financial outlook and a good track record of dividend payments, we think 3M is one you can consider if you want to invest in a top dividend stock. Philip Morris International, PM. The third stock on our list today is Philip Morris. Philip Morris is an American tobacco company that is a subsidiary of Altria. The company, just like its parent company, produces cigarettes, cigars, snuff, and fine-cut rolling tobacco. The company's most recognized and best-selling products is Marlboro, which sells in over 180 countries. PM will generate a total income of $31.4 billion in 2021 and a net income of over $9 billion. The tobacco industry has a history of being resilient during economic stress as customers keep using their products. This was no different for Philip Morris during the coronavirus pandemic, as the company's stock wasn't hit during this period. Although the global market meltdown temporarily affected the company, it didn't last long, as the company soon experienced a massive uptrend. At the height of the pandemic in March 2020, PM was trading at around $60 before setting a series of bull runs to an all-time high of around $110 in February 2022. The stock currently trades at $102, close to its all-time high. One of the reasons why Philip Morris maintains a buy rating is its moderate price despite its moat-worthy attributes. As a tobacco industry leader, PM is at the forefront of disruptive innovation as the industry shifts towards e-cigarettes, smokeless products, and heated tobacco systems. PM made over $30 billion in total revenue in the last 12 months after expanding its business to accommodate these new products. The recent acquisition of Zyn, a Swedish oral nicotine brand, has opened a way for the company to ply its operations in the US after its split from Altria. This move is also expected to generate more revenue for the tobacco behemoth. A look at the company's financial figures and growth metrics, and you can see that the company is doing well. The company is currently one of the top dividend-paying companies in the world, with a dividend yield of around 4.9%. This value is still way below its 4-year average of about 5.5%. PM also has a slightly high dividend payout ratio of around 84%. This poses a risk, as a high percentage of the company's earnings are used for dividend payments. Is there a risk that the company might stop paying dividends? The dividend payout ratio is not that high, considering that the company has managed to pay dividends for 13 consecutive years. The company also has 12 more years to become a dividend aristocrat after growing its dividends for 13 consecutive years. Although the EPS growth rate over the past 9 years has been slow at a rate of 0.2% annually, the dividend growth rate has been decent at 5% per annum over the same 9-year period. The earnings per share rate is projected to be better over the next 5 years at around 3% per annum, and the dividend growth rate is also expected to be at 3%. The company's return on invested capital is also very high at around 45% in 2021. The company has averaged an impressive ROIC of 38.5% over the past 10 years. At a current valuation of around $102, we think PM presents an excellent opportunity for investors looking for exposure to the durable nicotine market, as PM's IQOS heated tobacco products are gaining traction globally, and the company will hold the #1 oral nicotine brand in ZYN, which it recently acquired. With our conservative analysis, PM's dividend yield of almost 5% and a 5-year estimated annual return of 5.3%, the company looks like a quality choice for dividend growth investors, and you might want to consider it for your investment portfolio. Truist Financial Corporation, TFC. We have Truist Financial Corporation, TFC, for our next stock pick. Truist Financial Corporation is an American bank holding company formed in 2019 after the merger of Branch Banking and Trust Company, BB&T, and SunTrust Banks. The corporation provides commercial banking services, securities brokerage, asset management, mortgage, insurance products, and services. TFC is the 10th largest bank in the U.S. with $509 billion in assets. The bank has over 2,500 branches in 15 states and Washington, D.C. The coronavirus pandemic wasn't kind to Truist Financial. TFC stock fell from more than 50% during the pandemic to a price of about $27 in March 2020. It wasn't until the following year that the company could get back on its feet. In January 2022, the stock price rallied to around $61, the highest price recorded after the pandemic. TFC stock is currently trading at around $42 per share. As the fourth dividend stock pick in our video today, TFC recorded some impressive numbers in the company's third quarter results released recently. Most people own regional bank stocks during a Fed tightening cycle to gain exposure to rising interest income, which TFC provided. The company's net interest income increased by $620 million from the previous year to $3.78 billion. The company's yield of 4.6% is an industry high, and it is also higher than its 5-year average dividend yield of 3.6%. TFC has a low dividend payout ratio of 38%, dispelling any doubt that the bank may not be able to pay dividends. The bank has paid out dividends for 25 consecutive years. However, it has only seen consecutive growth in its dividend for just 8 years. The Great Recession impacted the bank's earnings for years, and it is just recovering from the effects. The EPS growth rate over the last 9 years stands at 7% annually, while the dividend growth rate over the same 9 years was better at 11.2% annually. We think that growth in EPS and dividend will continue in the next 5 years, but at a reduced rate of 5% annually for each metric. The return on invested capital, ROIC, in the last decade averaged around 4.6%, which is a fair value considering that TFC is a financial institution. Going by the recent success enjoyed by the bank, such as an increase in interest income, net margin, loan growth, 4.6% dividend yield, and expected EPS and DPS growth rate of 5%, we estimate that the company will give a total return of about 15% annually in the next 5 years. We think this is an attractive stock, considering its high dividend yield and high expected annual returns, so this is certainly a stock you could consider for your portfolio. VF Corporation, VFC. Our latest stock for today's video is the popular VFC. VF Corporation is an American global apparel and footwear company headquartered in Denver, Colorado. The North Face, Vans, Timberland, and Dickies are among the company's brands. The company has been operating since 1899 and has a market capitalization of $12 billion and sales of nearly $12 billion in the last year. VFC has 13 brands and controls 55% of the U.S. backpack market. Whether you are a lover of fashion or not, you've probably heard of or even rocked Vans and Timberland footwear. The company's stock price slumped to around $48 in March of 2020, and since then has been unable to hit its pre-COVID high, although it reached a high of $89 in February 2021. VFC stock is currently trading at roughly $28 today. After falling more than 60% this year, we think this company will be back stronger, as it has always proven resilient due to its being a conglomerate. VFC has historically been able to weather industry volatility and economic downturns due to the diverse product styles, price points, and consumer demographics that it serves, and this should be no different. Even with this recent price decline, the company's financials have been good, and the company's quarterly reports have been impressive, considering the meltdown in the apparel industry. With a whopping dividend yield of 7%, VFC remains one of the high dividend yield stocks of 2022. The company's 5-year average dividend yield stands at 3%, far from the current value of 7%. Although the dividend payout ratio is around 76%, VFC maintains a strong dividend position. The dividend payout ratio is quite high, which means there's a risk that it might cut its dividend. Even with this, it doesn't look like the business is not looking to stop paying dividends, as it announced its dividend increase a few months back. The announcement means VFC is the latest dividend king in America after the company has paid and grown its dividends for 50 consecutive years. VF Corporation's earning per share growth rate hasn't been great this decade, as its EPS has reduced from $2.41 to $2, a negative 2.1% growth in the last 9 years. Its dividend growth for the same period of 9 years was better, growing at a rate of 11.6% annually. Our conservative model predicts that the EPS growth rate will be way better in the next 5 years at 10% per annum, while its dividend will grow at 1%. Although the company's financial values were great, they were good enough due to the market's general situation and low expectations. We expect the stock to see a return of around 20.6% annually over the next 5 years. Although the company might struggle a bit in the short term and its dividend might need to be cut, this could be a good stock for the long term, especially with the company's high expected annual returns. Thank you for staying until the end of our video on top dividend stocks today. We will be happy to hear your thoughts and your favorite stock pick in the comments section below. If you haven't, click on the like and subscribe buttons, and we hope you have a great day ahead.